Welcome to another episode of Good Value by Antipodes.
Chinese equities have had a surprising rally this year, up 15%, and that's in local currency terms, making China one of the best performing markets, and that follows a 16% return last year. This is despite ongoing geopolitical tensions, especially with the US, and continuing scepticism from many global investors. So what's really happening on the ground? Today, I'm joined by John Stavliotis, who is fresh back from an intense week in China, meeting company leaders, connecting with investors, and getting a first-hand look at what's going on in the country's tech sector. We'll unpack John's key takeaways, from shifting sentiment and policy signals to where the most compelling opportunities are emerging. John, great to have you back on the podcast.
Thanks, Alison.
You and the team travel to China quite often. So what are some of your general observations?
Yeah, so we went to 3 cities and, just some of the very general observations. Traffic strong on the road, trains. You see the food and beverage outlets are quite busy. You don't really see the stores in the shopping centres that are very busy with people buying goods, for example. Food delivery penetration continues to grow from high levels. So a lot of the local investors getting coffees, teas delivered to the conference. Clearly they weren't happy with the Starbucks downstairs. And really that brings me to another interesting observation is relating to deflation, which is only strengthening, since the last time I've been there. One investor I spoke to was drinking a tea that he delivered to the conference that cost 8 RMB. That's just over $1 US. This is polar opposite to basically anywhere else in the world. Here in Oz, my coffee that used to cost $3.50 is now $5.50. And if you travel to Europe, US, for example, you're seeing high prices there as well.
China's economy has been facing headwinds from weaker exports and the property market crackdown, and that's all weighed on business and consumer confidence. What is your sense of how the economy and the consumer are travelling?
Yeah, look, to summarise it in one sentence, the tone from the companies was neither bullish nor bearish. And I'll go into more detail by breaking it up into property and consumer separately. But clearly they're very, very linked. Look, property market was very strong in Q1. That was across secondary transactions and really in tier 1 cities, in new homes as well, and in pricing. Developers were building up their land banks, something we haven't seen, with enthusiasm for some time. One developer we met said that they stopped buying land in April because the market got too hot. But, since start of April, Liberation Day, there has been a bit of a slowdown. Buyers got concerned with that sort of global uncertainty. But it hasn't been as big of a negative impact you may have expected. For example, May holiday was quite strong. And it's also hard to read because April and May are quite seasonally weak months. So really we'll be looking towards June to get a real read on what's happening. But, all the high frequency data we're tracking is showing, volume transactions being resilient. And prices sort of remaining quite stable in that top tier cities. On the consumer side, the environment remains steady since the October stimulus announcement. That's actually pretty impressive. When you look at recent stimulus rounds that have occurred in the last 3 years, it's usually only helped for a few months. This is now almost 6 months since that stimulus happened. And, it is quite mixed across sectors. So in some areas it is quite strong. For example, local travel, food experience, large ticket items still remains somewhat challenging. The consumer companies are battling that deflation that I was talking about, but it is stabilizing in some sectors. The one that I'll call out is that food and beverage sector. Although that bubble tea was quite cheap, in certain categories of that, it is actually now stabilizing and we are seeing a return to growth. One example is a portfolio holding China Resources Beer. We met them and they're seeing continued improvement through this year and they're cautiously optimistic heading into the important summer period.
You were also in China when the news broke out about easing tariffs and the 90-day tariff negotiation window. What was the reaction from companies and investors? More confident or still wary of that backdrop? And how destabilizing can tariffs be?
Look, there's general consensus that decoupling from the US is inevitable. Companies that can move their operations out of China already have. China's effectively been in a trade war with the US for about 8 years since Trump got in on his first term, really. But in some industries, the Chinese manufacturing is just too far advanced, and that's because they've got fully integrated supply chains, etc. And even with tariffs, they are just too competitive. And an example of that is the EV battery space, where we'd find it hard to see competition outside of China, regardless of the tariff rate. In terms of how people are seeing this, there was really no panic when it came to tariffs and that impact on the broad economy, and that's really explained by the fact that the US, it's not as large of an export partner as people make it out to be. And what I mean by that, even if you include a reasonable estimate of goods that redirected through other countries, US exports from China account for about 3.5% of GDP. So tariffs will be, if they remain at a higher level or increase from the current estimates, they'll be very disruptive for certain companies and some industries, but they won't destabilize the economy.
That's a really interesting point, actually, because I think, you're right, that 3.5% of GDP is going to be lower than most people expect. Was certainly lower when I first was lower than what I expected. And it does affect a certain part of the economy, but not the economy more broadly. But how do you think, we've heard a lot about stimulus. There's been a lot of noise about stimulus. How do you think all of this ties into China's stimulus plans?
Yeah, look, the very simple way to think about it is that 3.5% of GDP makes it very feasible that the CCP can offset the impact with a reasonable amount of stimulus. And look, it's not going to come from, building, an extra 5 million houses in cities that don't need them. It's clear the government wants to stabilize property, not feed a bubble. So this really leaves consumption as where stimulus can be directed. So, this trade war could actually result in a healthy rebalancing of the economy, which has long been criticized for its reliance on investment. In terms of timing of this stimulus, there is quite a bit of uncertainty here, right? So the recent deal, and there's a lot of exemptions to tariffs, etc., means that we think the economy will probably hold up pretty well in the near term. Or at least better than initially expected. So the government may not need to stimulate, and because they won't if they don't need to. On the other side of that, there's strong evidence of a policy put. That is, if the economic data worsens, whether it be because of trade or any other reason, the government will step in. Then the next important meeting to watch for policy news is the July Politburo meeting. This is another one of those big meetings where they assess the economic data and they compare it to their targets. So we'd expect some information on near-term stimulus at that.
Let's shift gear to the structural growth opportunities. You were able to attend some robotics, AI, and autonomous driving tours. So what impressed you and what didn't impress you?
Yeah, it was really interesting going to these companies' showrooms and meeting them in person. On the robotics side was probably the most unimpressive, surprisingly. Compared to what they show you on the videos, these robots in person were kind of clumsy and slow. Think of C-3PO, which, who in Star Wars. But what we got from these meetings was there's a lot of investment going on. And that's because the government's subsidizing any company that has any technology or know-how in humanoid robotics. So they're all investing in humanoid robotics. The market is willing to give these companies a low cost of capital to invest. So the lesson I got from those meetings was that the development of these robots is likely to be very fast. Investing in the companies that are doing the humanoid robots is probably going to be very hard because of the competition. And we're looking for opportunities in, call it the picks and shovels side. So, for example, companies that are, providing the actuators or other hardware components to make these robots that may be operating in more consolidated markets and can sustain their position as the industry grows. Shifting to autonomous vehicles, this was very impressive. The autonomous taxis were better than I expected, and from discussions with other investors, they're actually probably a bit more impressive than what you see from the likes of Waymo in the US. But it's going to take time for these autonomous taxis to take over, for the lack of a better word. The challenges is not so much the driving through the city; it's issues like where do you drop off, where do you pick up, what about if there's a road blockage, for example. So the companies we met with currently have one person per 5 autonomous vehicles that never take over control of the car, but they'll talk to the car and direct it in those moments. So that really means that, the companies we met may have 300 cars in the city. To get to 1,000 cars has a lot of challenges. Then to get to 2,000 cars has a lot of challenges. So this is going to be quite a slow process, but an inevitable one given the quality of these vehicles. We're investing in Didi, which is the Uber of China, 75% share in ride hailing. What we learned from this trip is that the value of having that customer network, which is having cars get to the customer quickest, you'll still need human drivers, and they will still get paid a lot better on Didi than any other platform because of that share. That remains a big advantage. And all the companies that we talk to are looking to partner with someone like Didi to be able to get the best of both worlds, as it's going to take time to get to fully autonomous. So that was kind of supportive of our case.
And with that one person controlling those 5 cars, that's happening in a
warehouse or office somewhere. And he never takes control of the vehicle.
Before you go on, I'm sorry to interrupt, but did it feel weird?
No, it was actually surprisingly comfortable. And the car really drove, it felt exactly like being in a taxi with a human driver. It overtook a car that was too slow. It was handling all the situations quite comfortably.
I've seen these videos and you see people sitting in the back and then the steering wheel just sort of spinning by itself like a ghost driver. It just looks so surreal.
Yeah.
Anyway, I didn't mean to interrupt. Tell me about your AI tours.
So on the software, we met a bunch of software companies and really talked about their investment in AI applications. And what we're seeing is they're using AI to develop, new solutions very rapidly. The uptake is very strong, but as is typical in the Chinese software market, customers don't really want to pay for these applications, right? So you can see what our case is as this AI gets integrated, it becomes more useful for customers. And that's basically the strategy that's being employed. As the software gets used more often, it provides a greater use case to their customers. They can increase that subscription ARPU. And there are companies like Kingdee that are doing a very good job at this. So, it's one of these things where the AI investment's happening right now, but the upside is going to come over the medium term.
And sticking with that AI thematic, we're talking about DeepSeek, made its grand splash earlier in the year. And look, it really did put China back on the AI radar. So how do you think China is positioned in the global AI battle? And you sort of touched on it already, but can you spend a little bit more time on where you see the benefits of this investment in AI accruing?
Yeah, so the DeepSeek moment was meaningful for China, but for adoption of AI globally, really. So to bring it back to what they did, they fine-tuned those foundational models and were able to deliver a model or certain applications a lot cheaper and with less hardware requirements. And that's important because China can't get all the hardware, right? The performance of this model, interestingly, was in line with the best out of the US just 3 months earlier. So really, the outcome of this change, we think, is the best way to play AI is moving from the enablers in the early stage, which was NVIDIA, tech supply chain, etc., to the adopters. And, in China, that's really opportunity to invest in software, internet companies that are implementing that AI to generate more revenue and generate more solutions, kind of like what I talked about earlier. And this is going to be a global theme. To give an example from a stock perspective, Tencent is a perfect example in China. So they run WeChat, which is the dominant communications app in China, used by everyone, basically. And they're involved in everyday life in many ways. Like, for example, digital payments, they've got a dominant position there, social media, gaming, etc. Its apps have got globally best-in-class engagement levels, numbers that you rarely see elsewhere. But its monetization has lagged that of peers around the world. So here's an opportunity where using AI will shift some of those use cases to things that are more easily monetized. And effectively, they can close that gap to, dollars per time spent is the way to think about it. Tencent's aggressively investing in AI now to develop these capabilities. So, for example, in the last year, 80% of the GPUs that they bought have been used for internal AI developments. And that compares to, for example, Alibaba, where 60% were actually bought and then effectively lent out in their cloud business. So a lot less, value add being created. You look at a stock like Tencent is trading on 18 times this year's PE, and we think it's going to be a stable double-digit grower into the long term, given its dominant position in the Chinese ecosystem. So from a risk-reward perspective, this stock is very attractive.
Perfect segue, because we want to bring it back to the portfolio. You've just taken us through the Tencent case. Where else are you finding the most attractive investment opportunities in China?
We continue to see many attractive opportunities in China. We're overweight some of the structural growth opportunities from electricity grid investment companies that's required given the acceleration to renewables, to the software and internet companies that we've talked about benefiting from AI. One of the things we've done recently is we've increased our exposure to consumer and property sectors. And, I think it's an interesting one. We see the macro environment remaining fairly stable, so not really accelerating. But we think there's an attractive risk reward given that context of the policy put that we talked about. We're able to buy these companies that they're very resilient. They've been growing through this challenging macro at very attractive valuations. So, an example here is a property developer. For the first time in a long time, we own a Chinese property developer in China Overseas Land. They led the market with 9% share of contracted sales amongst the top 100 developers last year. They're a state-owned enterprise, and they focus on tier 1 and tier 2 cities where the market's already stabilized, and they've got a very strong balance sheet. So we think that positions them very, very well to win. And the important thing is that share gain can provide really attractive investment opportunities, even if the recovery happens at a slow pace, which is what we'd expect in China. And, to give an example, I'll point you to the US where, post the 2008 financial crisis, D.R. Horton, which is one of the leading developers there, significantly outperformed the S&P 500, even though it took over 10 years for the market to get back to 2006 level of new starts. It just took share, grew profitability, and gave a very good shareholder return over that period. So China Overseas Land is currently trading on 0.3 times book and 8 times PE on current year estimates. And we think this is the start of a very steady recovery that will drive a very strong return over the medium.
And that's such an interesting comment, isn't it? Because, we've had this big clean out in the property market and massive consolidation, I think, is sort of what's happening here. And as you say, even though you're not expecting volumes to significantly increase from where they are now, but when you have fewer players competing or fewer players left to compete in that space, you can see very strong growth from the last men standing, so to speak. And their state-owned enterprise status, presumably households feel a little bit more comfortable.
Well, yeah, exactly. They're comfortable to buy off them, and they've got a lower cost of capital. So, Colliers, with their level of debt, their funding cost is, at a big advantage even against the best private developer.
And as a consumer, you feel relatively confident you're going to get delivery at the end of that period. So if you're going to buy a home, that's probably not a bad developer to buy it off.
Yeah.
So that's a good example of perhaps picking where people might be too frightened to start investing just yet, but getting in before the inflection is how you get the most out of it. Now, on the flip side, what areas of the market are you steering clear of, and what's driving that view?
One of the things I'd mention on this topic is, we're scrutinizing valuations and investment cases, very thoroughly, particularly in China. And that's because we want to ensure we're getting paid for the risk that, that comes with the volatility and the fluidity of policy that we're seeing, in China and frankly in the US. But China's kind of a target of that. So, that's one thing that I'd like to highlight on this question. But, and then the other thing, just areas that we're cautious on is particularly in that exporter space, even though, we're seeing trade deals, we're seeing certain areas being exempted, this area is going to see elevated risk for some time globally. So we are careful there. And, another area I mentioned is a cautious approach to, that whole manufacturing and associated supply chain and that area is being disrupted with trade policies, but also with weaker demand locally that's basically driving up competition. And some of these areas are still trading on high valuations. An example there is the Chinese auto industry.
Perfect, John. Thank you so much. Some great insights as always, and pleasure to have you back on the podcast.
No, great. Thanks for having me.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.